Hi everyone, welcome to this week's Advisor Market Update. This week highlighted how innovation cycles and policy shifts create market opportunities. From Apple's iPhone 17 momentum to strategic healthcare moves, we're seeing companies positioned for growth while Fed policy changes are reshaping commodities and global bonds. Here's what matters most for advisors and clients. Let's start with individual companies and what their moves tell us about broader trends. Apple just received the most bullish analyst call on Wall Street. Wedbush raised their price target to $310 from $270, pointing to iPhone 17's demand tracking 10 to 15% ahead of last year's model. This isn't just about one product cycle. We're seeing pent-up demand from users holding older devices, renewed growth in China, and Apple's continued ecosystem expansion all converging. For a company already commanding premium valuations, this sustained hardware growth combined with services expansion shows Apple's market leadership remains difficult to challenge. The timing coincides with broader consumer tech recovery, positioning Apple to capture disproportionate share as discretionary spending recovers. Tesla also drew renewed optimism. Baird upgraded the stock to outperform with a $548 target. The firm highlighted Tesla's evolution beyond the automotive industry into robotaxis and humanoid robotics. This represents a fundamental shift in how analysts value Tesla, moving from traditional auto metrics to platform capabilities. The emphasis on Tesla's steady cadence of catalysts suggests confidence in execution across multiple fronts simultaneously. With capacity expansion proceeding alongside product diversification, Tesla is building infrastructure for multiple revenue streams that could justify these premium valuations. It's estimated that by 2035, robotaxis can be 55% of Tesla's $400 adjusted EBITDA, which is around $220 billion. In healthcare, Pfizer made headlines with its $4.9 billion acquisition of Metsera, potentially reaching $7.3 billion with milestones. This marks Pfizer's aggressive re-entry into obesity treatments, with early data showing a possibility of 8.4% weight loss in just 36 days. Metsera's approach could differentiate in a market projected to hit $100 billion by 2030. This reflects Pfizer's broader strategy to rebuild growth following the COVID-19 revenue declines. The obesity market represents a rare combination of massive opportunity with strong pricing power, as these treatments are increasingly recognized as medical necessities. Now, let's move on to the broader economic signals and what they mean for positioning. JP Morgan's analysis shows commodities are positioned for a Fed-driven rally. History shows commodities can perform strongly after initial rate cuts when growth stays steady and inflation moderates, with precious metals typically leading. This reflects a fundamental shift in market dynamics. Lower real rates reduce the opportunity cost of holding non-yielding assets, like gold, while supporting industrial demand through easier financial conditions. The current environment presents ideal conditions for this pattern to repeat, with inflation concerns subsiding while economic growth shows resilience. Meanwhile, Bloomberg Intelligence argues that the Fed may need to cut rates below 3% to achieve meaningful yield curve steepening. That's significantly deeper than current market expectations. With Chair Powell acknowledging that policy remains restrictive, markets are positioning for extended easing cycles contingent on labor developments. This suggests current Fed projections may prove too conservative. The implications extend beyond rates themselves. Sustained curve steepening would benefit banks, insurance companies, and pension funds, while signaling a return to a more normalized policy transmission. Bond managers are also finding opportunity in the middle of the curve. Major institutions are concentrating on 5 to 7 year treasuries, which have delivered 7% year-to-date returns. This belly of the curve positioning offers positive carry while providing insulation from volatility and benefiting from Fed easing expectations. This strategy reflects sophisticated risk management in uncertain policy environments, capturing yield while maintaining flexibility. Now, let's look at where opportunities emerging from these dynamics. Dollar weakness is unlocking emerging market opportunities. Fed rate cuts are driving dollar weakness, and fueling this represents more than currency appreciation. This reflects fundamental improvements in EM fiscal positions, current accounts, and inflation dynamics that make these markets attractive on their own merits. Currency dislocations of this magnitude historically create multi-year opportunities for diversification and carry generation. With developed market yields constrained by central bank policies, EM bonds offer both yield pickup and potential capital appreciation as global capital allocation rebalances. So, what are this week's signals telling us? Corporate moves reveal companies' positioning for multi-year growth cycles, from Apple's hardware momentum to Tesla's evolution to Pfizer's strategic healthcare pivot. The macro picture shows that the Fed policy is reshaping opportunity sets across asset classes, from commodities benefiting from Goldilocks conditions to emerging markets gaining from dollar weakness. And in fixed income, sophisticated positioning in curve dynamics and international diversification is creating compelling risk-adjusted returns. Thanks for watching, and we'll see you in the next update.